Welcome to the Passive Investing Show. I'm Ashley Wilson, and I'm joined here today with my co-host, Jay Scott. On today's episode, we interviewed Mauricio Rauld from the Premier Law Group. And we know Mauricio very, very well because obviously he is our go-to expert for all of our personal syndications that we do in multifamily.
Yeah, Mauricio is fantastic. And I'll tell you, when we first talked about having Mauricio on the show, the obvious thought was, let's have Mauricio come and talk to us about multifamily syndication, how it works, answer all our questions, because he is the securities firm that we use to do all of our compliance work when we do our large real estate deals. But talking to Mauricio, what we realized is he invested in an asset class that, I don't know about you, Ash, but I know essentially nothing about, but I've always been interested in. And so I asked if he would kind of, instead of talking about syndication, if he would come onto the episode and talk about oil and gas investments. Because again, I knew nothing about oil and gas. I know people that are investing investing in oil and gas, but I never really knew the benefits, the drawbacks, the mechanics of how those investments work. But Mauricio does know all that stuff, and he's here today to tell us all about oil and gas investing, why we might want to invest in it, the benefits of investing in it, as well as some of the drawbacks and the risks. So I'll let him tell the rest. And without any further ado, welcome Mauricio Rauld to the show.
Mauricio, welcome to the Passive Investing Show.
Well, thanks for having me, Ashley. Really excited to do it.
Jay and I are so excited to have you on. But first, before we dive in, could you talk a little bit about yourself and how you got into oil and gas?
Well, as you guys know, I'm first and foremost on the professional side, a syndication attorney. I'm a real estate syndication attorney. I founded a firm, a Premier Law Group, and our team essentially helps real estate investors, syndicators stay out of jail. So that's kind of my day job. But, obviously that's obviously takes up most of my time, but that's allowed me to look out into the investing universe and look at some stuff. And I've been doing a lot of investing now for, over a decade, obviously. And I'm kind of, let's call it an asset agnostic investor. And so, I'm really into sort of macroeconomics and kind of big picture stuff. And so I'm always just looking for something that's interesting. And this oil and gas thing came along on my radar a few years ago, and I did a little bit of a deep dive and I was really attracted to it.
Yeah, so for anybody that doesn't know, so you run a law firm. What's the name of the firm?
Premier Law Group.
There you go, Premier Law Group. I knew that because Ashley and I are clients of yours, longtime clients of yours, and you guys do all of our SEC compliance and securities work for our syndications. And so we are familiar with you, Mauricio. But for anybody that's not familiar with you, can you take us back a little bit and just kind of talk about your investing journey? So at what point, obviously, you've been an attorney for a long time, you've run the firm for a long time, but at what point did you really start thinking about your passive investments and basically building wealth?
Yeah, it was actually right before I decided to first go to law school, and then before I started to look into practicing law. So back when I was in college, I was very, very interested in real estate. This was back in, I don't even want to date myself, but this is, what is this? This is like, 1995 to 2000 time frame. Really interested in real estate. I don't know if you guys remember, if you guys are old enough to remember the old Tommy Woo and Carlton Sheets infomercials back then. But that's kind of how I got, into this whole thing, got really pumped about it. And I really made a serious look into maybe becoming a real estate investor instead of going to law school. I didn't really want to go to law school, to be honest with you. It was kind of like I didn't know what else to do. And so I'm like, hey, if I'm going to do this, this would be a good time to do it. And even after I went to law school, before I started practicing and took the bar, I said, this is another chance for me to, if I'm going to do this real estate stuff, let me do it. And so real estate was where I kind of got introduced to this whole investing thing, primarily through, Robert Kiyosaki, Rich Dad Poor Dad. You guys obviously, I know you guys are big fans, and a lot of your audience members are big fans, but that's really what got me kind of on the mind frame of investing, because I knew, thanks to that book and thanks to a lot of circles that I was running into, is that, busting your butt for, 30, 40 years being a lawyer and just, working your butt off and having a 401k and doing the stuff that most professionals do wasn't the kind of life that I wanted to. And the only way to kind of get out of that rat race or do something different would be get into the investing world. So it's been on my radar probably since about, the late 1990s, early 2000s, I would say.
And what asset classes are you most focused on?
Right now, it's oil and gas, and there's a very specific reason for that. But the three, I would say, oil and gas, real estate. I don't really do any active real estate anymore, so most of my real estate is in sort of the passive world, the syndication world. And then I'm also a big precious metals guy, but I don't necessarily consider that an investment per se. But those are kind of my three asset classes that I pay particular attention to.
I do want to talk about precious metals just for real briefly, because I get asked this question all the time. I own some physical gold and silver, and also I do some derivatives, some trading options and gold and silver. And so everybody kind of has a different idea on why we use precious metals in our portfolio. I'm just curious, what's your thought there? Is it an investment? Is it a hedge? Is it what are your thoughts on precious metals?
Yeah, if we're talking about sort of precious metals in the bullion form, which is what I do, so I actually purchase physical precious metals, coins, bars, what have you. To me, that's not even I don't look at it as investment or even a speculation. I look at it as insurance. To me, that's kind of my insurance policy, and I don't really care about the price, so to speak. I buy precious metals, and specifically gold. I have some silver, but it's specifically gold, and I just buy it continuously, whether the price is up or down, because I want to keep a percentage of my portfolio in gold, so that if the what hits the fan, that should historically sort of offset any catastrophic event that would happen somewhere else. So I look at it primarily as on the bullion side as insurance. Now, if you think, hey, look, gold's going to double or triple or quadruple here in the next 3 or 4 or 5 years, then I think you can start looking at some other options like miners and some stocks that are sort of derivatives of that. But if you're buying bullion, most people that I know buy bullion as sort of like you said, a hedge, as an insurance policy.
Yeah, I know there's a lot of talk these days, especially with the economy potentially at a peak, maybe even over the peak. A lot of people talking about buying physical gold, physical silver. I hear this at the beginning of every kind of economic downturn, and I think what people don't realize is it's not a good investment from the returns standpoint, because you're going to pay a tax on the purchase, you're going to pay a tax on the sale, you're going to pay to have it shipped to, you're going to pay to store it, you're going to pay like when you go to sell it, you need to figure out how to get it to whoever you're going to sell it to. So basically you're getting nickel and dime on fees and transactions the whole way. But like you said, I think it's a great catastrophic risk hedge.
Yeah.
If the power grid goes down, for example, or if there's a run on the banks, and I'm not saying either of these things are likely, but who knows? And just having some physical metals, or if there's just a big drop in the value of the dollar, most likely gold, silver is going to go up in value. So yeah, I'm right there with you.
And Jay, there's a way to I'll say liquefy. It's not the right word. You can have some liquidity there, because there are several well-respected and largely capitalized institutions that will actually loan you on your gold, and it's usually about 70 to 75%. And so there is a way for you to actually extract some of that equity in there, sort of like a refi in your home, without actually having to sell and incur that high tax, because as you know, precious metals aren't even taxed as regular capital gains, they're taxed as collectibles. And so the tax rate, I don't even know what it is, I think it's in the high 20s or low 30s. But if you take a loan against it, if you've got $500,000 of gold and you want to pull out $200,000 to go buy a home or buy an investment property, you can pull $200 just like you can pull equity from your home.
I think this brings up a great point, because at the end of the day, investing isn't always about your direct return. So there's a lot of different reasons why people invest in different asset classes. And I think that is a great segue into why potentially, I mean, I don't know, I'm interested to hear, but why did you choose oil and gas?
Yeah, so, most people, I think, correctly so, think of me as sort of a real estate person, a real estate guy, not only because of my affiliation with a real estate guy specifically, but I'm a real estate syndicator, so everybody would think, hey, I'm an investor in real estate, and I am. But I have a problem, which I think a lot of your listeners have, which is I have a tax problem, right? So I have a kind of a high earning. It's not really a W-2 because I own the firm, but it's a high income, which means I pay high taxes unless I do something about it. So I've got to spend a lot of money on really good tax planners, and luckily I've got a good one. But I've got to look of ways, what can I do to minimize that tax? And I think for most passive investors and most real estate investors, or I want to say passive real estate investors, they look to real estate because of the tax benefits. That's one of the many, 4 or 5. If you ask me what are the benefits of real estate, I can probably rattle off 3, 4, 5 of them. And one of the main ones is the tax benefit, right? The bonus depreciation, the 1031 exchange. I mean, all of that stuff. There's really, if you do it right, there's a way to basically get tax-free income if you're doing it through the vehicle of real estate. Especially if you're a real estate professional, right? But I'm not a real estate professional. I don't have time to be a real estate professional. So I don't have that option. And so even though I have some benefits on the real estate side, I don't have all of the benefits of the real estate side. But oil and gas is probably the other one. So there's real estate, to me, is one of the top two vehicles to mitigate your tax problem. The other one is oil and gas. And specifically, and I don't want to, first of all, I'm not a tax professional, so as you guys know, but specifically, it's not just any oil and gas, but it's really having what we call a working interest in an oil well. And there's a bazillion ways to do that. But the oil and gas that I specifically invest in, the main reason I do it is because it allows me to offset multiples of the investment against my active income. So for example, if you were to invest $100,000 into a properly structured oil and gas investment, I can offset 200, sometimes 300,000 against my active income, right? So that's a big deal because not only am I offsetting against my W-2s where if I did the same thing with real estate, I can only offset it against my passive income. But because of the leverage, just like in real estate, you're leveraging it, I can get multiples of that deduction against my taxes. So you can get into scenarios if you can find, which are hard, sort of a 3x multiple on that, like $100,000 writes off $300,000 of income. I mean, you can see how really quickly you can pretty much eliminate all of your active income just through this investment vehicle. And my rationale for doing this, because there is obviously an element of risk, and you could argue a high element of risk, but my rationale here was, hey, look, worst case scenario is I lose my entire $100,000 investment. But the alternative is I could give that $100,000, I would have to give that $100,000 to the IRS. And the IRS, I'm definitely losing my money in the IRS. I'm not getting any of that money back. So I'm like, hey, I'm going to lose my money either way. I've got to pay $100,000, $200,000 of taxes. I'm going to lose that money either way, either to the government or to this investor. And maybe I don't lose all my money. Maybe I do get a return. And this has actually been providing a pretty handsome return, which almost seems a little bit unreal. And so there is a risk factor involved. But like I said, worst case scenario is I lose it all, but I would have lost it all already giving it to somebody else.
Can you walk us through the mechanics of the tax break? So on the real estate side, it's obvious to me. You have this thing called, well, there's a few ways, but there's one big thing called depreciation. And basically it's the government, the IRS, says that because you have this depreciating asset, the physical improvements on the land, the buildings, because they physically get distressed and because they depreciate in value, they're going to allow the investor to take this paper loss every year against that depreciation. In an oil and gas investment, presumably there's no depreciation that you're taking the loss against. So what is that tax benefit? What's the IRS saying? This is the thing we're going to give you a deduction for this type of investment.
Yeah, well the investment I particularly do actually does have a depreciation component to it. In fact, one of the, I'll say negatives of it, but we are purchasing a piece of equipment, and that equipment will go to zero in 10, 15 years from now. So that's not it's not like real estate where you get to depreciate something and it continues to go up in value. This particular equipment that we purchase will go to zero. Now there's some discussions as to how long it will last before it goes to zero, before some of those parts of those equipment start deteriorating. And then there's a question of, well, can we refurbish it? Can we put in a couple more $100,000 into it, and then we can just refurbish it and we can extend the lifeline for another whatever 5, 10 years. We don't know that, to be honest with you, because these equipments have only been, I think the longest one that's been in there is 7 years. But the manufacturer thinks it'll last 15 years, but it is actually a legitimately depreciating asset. But I think like real estate, and again, I don't know the intricacies of the tax code, but just like real estate, the government, look, my good friend Tom Wheelwright likes to say that the tax code is just a roadmap. It's just a series of incentives for what the government wants you to do. And the government wants you to provide a roof over people's head. That's why they encourage people and give all these tax breaks for real estate investors. So the government wants you to put that money into real estate so that you can provide housing for other people. Energy, as we all know today, is something that the government has a huge incentive for people to put money into, because we need energy, whether it's oil and gas or whatever we're extracting from the ground, we need that. And so the huge amount of tax benefits goes into oil and well investments to incentivize people like me to invest in things like real estate and oil and gas, as opposed to buying Apple or going to buy a car wash or what have you. So, but that's the thing; it's depreciating. And then the leverage, it's just like anything else. Like, we're not getting, it's a piece of equipment, so we're not getting 80% loan to value or 70% loan to value, but we do sometimes get 50% loan to value. And I think the most we've gotten is 60% loan to value. And so we get to do that for the entire, for the entire amount of the equipment because it actually is depreciating over 10 to 15 years.
So for a typical oil and gas investment, let's say the example that you gave, what are you investing in? So you're investing in the equipment. Are you investing in the land? Do you benefit from at the point that you invest, do we know that there's oil underneath the soil and you're going to make money, or are you going in? Are there different points where you can invest high risk at the beginning before we know there's oil there, and lower risk later when we know there's oil there, but we don't know if we can get it out, and then even lower risk later when you know you can get it out, but you don't know if you can sell it, blah, 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 blah.
Yeah, so there's, when you're in the oil and gas business, there's all the timeline of the spectrum goes from the most speculative oil, which is kind of what you talked about a little bit, where it's like, I just have a piece of land. I don't even know if there's any oil or gas underneath, or maybe I do know, but I don't know how much. And you start exploring. That's called exploration, right? You start just digging a bunch of holes in there to see if you can strike gold, right? That's the highest risk reward, because if you strike oil, great, your investment hits. But if you don't strike any oil, your investment goes to zero, which is what I think most of the experiences I've had is that. And then you have the next level, which is like, now we have proven reserves. We've got a piece of land. We know it's got oil. Now it's time to extract the oil, and that has a capital cost or whatever. And then I think I would categorize ours into the last category, which is land that has depleted oil and gas. So there was at some point there was a lot of oil. And we basically sucked out all that oil over time, or somebody has sucked that oil. So there's not much oil left. In fact, the oil is really trapped into rock. At this point, you have saturated rocks. You don't have a pool of oil down there. It's just all saturated rocks. And so what we do is we have a piece of equipment that essentially attaches to the oil and well gas and is able to, what we call enhance recovery, meaning through typical recovery methods, we can't get any more oil out of the ground. We've already sucked it all out. But through this mechanism that we have, this technology, we can actually extract additional oil that otherwise we would not have been able to get. And when I say we, the oil companies would not have been able to get, and we get to share in that revenue. So every additional barrel of oil that we help pull out, that the oil and gas company wouldn't have been able to pull out without us, we get a cut of that, a percentage of that, additional margin. And that's kind of how we make the money. But putting aside the tax thing, the easiest thing, the way I can explain what we do is it's essentially we buy a piece of equipment and we rent it out to the oil companies to use. That's really what we're doing. And instead of getting a monthly, rental income, it's just a percentage of their profits or excess profits. Now, we don't structure it that way, because if we structured it as a rental, there'd be no tax benefits. And so we've structured it through all the tax advisors in a way that we actually have a working interest in the well, and we're sharing the profits of that well. But putting all that stuff aside, you're basically buying a piece of equipment, leasing it to an oil company or somebody who's extracting oil, and just getting a profit share of that revenue.
Interesting. And when you say we, is this structured as is this a business that you're investing in the business? Is this a syndication type entity where you're investing in one piece of equipment in one entity, and you can potentially invest in multiple of these entities? Who's running these types of deals, and are they big companies, small companies?
Yeah, so this is obviously a passive investing show. This is completely passive. So so you're investing in a particular piece of equipment, and there's multiple of these. I think there's about 70 or 100 of these. So each equipment, costs, depending on the size of it, maybe $1.2 million, $1.5 million. And so that typically gets syndicated. So theoretically, you can come in and invest $1.2 million, $1.5 million and get the entire thing. But usually it's in $100,000 chunks, because there's a syndicator who's putting this together and raising the 1.2 or 1.5. So it's a totally passive investment. And then the operator, who actually is not necessarily the owner of the land, but the one that's actually in charge of extracting the oil, that's the company that's actually builds this technology, this I call it a pipeline, but it's really sort of a machine. It's just a machine, man. I look at it as a sausage factory. Something goes in and something goes out, but it's that machine they actually build, and then they manage the whole operations. So they have all the contracts with the big oil and gas companies. They're the ones who operate the machinery. They're the ones who keep track of all the, of all of the revenue and the barrels of oil that come out of the ground, and then the ones that give you the accounting, and they basically do all the work, and in exchange for that, obviously they get a nice cut of the revenue as well.
Shifting gears a little bit with respect to the investor returns, and I know that wasn't the motivating factor of what gravitated you to this asset class to invest in. However, with respect to the investor returns, what do they look like? Is there quote unquote cash flow along the way? Is it only realized at the end? What can, if someone's listening right now, what can someone expect as a typical return?
It's a little bit tricky, but no, this is a cash flow play. So you're not going to buy the equipment and then sell it for a capital gain. In fact, as we mentioned earlier, it is a depreciating asset and it will go down to zero at some point. It's like you just bought it's similar to you buying a car and using it for Uber, I guess. At some point that car is going to not work anymore, and you can try and fix it up and refurbish it and keep extending the life of that car to use it for Uber, but eventually that car is going to be worthless. Same thing, this thing's going to last maybe 15 years. Maybe we can fix it, maybe last 10, maybe last 7, we don't know. And so it's purely a cash flow play, but it cash flows really nicely because, energy, people need oil and gas, and certainly now with the barrel of oil being at, whatever it is now, just hovering above or below $100 a barrel as the time of this recording. But the returns, they depending on the structure, we've been getting somewhere in the, 25 to 50% returns on cash. Now, the 25 actually, remember, you're putting in $100,000. This is a very important point to people. Remember, you're putting in $100,000, and then at the end of the investment, you're not getting that $100,000 back because it's gone. It's depreciated. So it really does depreciate. So you've got to factor that into the final return, because unlike real estate where you put in 100, you get back 200, so you've made 100,000. Here, when you get back, you're not getting that initial investment back. So that's an important thing to remember. And the other thing to be very important to remember, which is a huge roadblock for many, and this is just a risk-reward analysis, like any investor has to do their own due diligence, there is a significant risk, right? Because one of the requirements, and this goes into my, I sometimes talk about asset protection and stuff, and we talk about privacy and tax and asset protection, and we sometimes talk about, that you can't always have all of them. And this is an example where you can't have all of them. So in order to get the tax benefit in this particular investment, you have to be a general partner in the limited partnership. You have to be, and you have to be in your personal name. So you can't hide behind an entity. You can't, have a trust. It's got to be your personal name as the general partner, which means you have unlimited exposure should something catastrophic happen and it's not covered by insurance. So if there's some huge explosion at the oil well site, something screws up and a bazillion people die, and yes, the oil owner is going to be sued, the operator is going to be sued, but this is a piece of machinery can also get sued, and the owners, which is in a limited partnership, would get sued, and then you as a general partner would also potentially get sued. So that's one of the big risks involved in this particular investment.
You said something interesting earlier. You were talking about the machine equipment depreciating. In real estate, obviously, when we utilize depreciation, there's a recapture upon sale. Is that the same situation with this type of investment? And how does that work if there is a recapture?
There's no recapture because there's no market really. I mean, maybe there's a market, but you're not selling this piece of equipment, right? It's almost like you guys are familiar with sort of these ATM deals as well. It's like the ATM at some point, it's just worth, you bought it for $10,000 and it's worth nothing, and you might be able to sell it for scrap metal. And that's, I think, what this would be sold for. Once this machine stops working or to get it refurbished, it doesn't make economic sense anymore. Now you're just left with a bunch of metal, and you would literally sell it for scrap metal. So there isn't going to be any recapture at that point. And especially the way this particular investment is structured, you're actually exiting prior to that event happening. So there's a call option. You just get taken out, and you get what you get. And if you want to reinvest into the next machine, you can do so.
So let me ask you a question on timing. So we've talked about cash flow. We've talked about the tax benefits. We've talked about these investments basically fully depreciated. You're not going to get any of your principal back. So it's probably a 10 to 15 year investment. at what point are you getting the tax benefits? At what point are you getting the cash flow? Do tax benefits, are they front ended? Are you going to get most of those on in year one, or are they spread out over the deal? Cash flow, is it going to be like a year or two before you start seeing any profits, or do you see that in year one, or maybe you see that in year 10? What's the timing look like for both the tax benefits?
Yeah, I think of the tax benefit as the bonus depreciation. It gets taken in year one. So you get the entire 1x, 2x, 3x, whatever the tax break is going to be in that year, when the equipment was put into service. That's the year, the tax year, that you're going to get the tax benefit. And then the cash flow starts usually about 6 to 9 months. It depends on where the machine is, but if they have to build the machine, there's a lead up to build the thing. It might take 3 to 4 months to build it, and then they got to put it in service, and they got to find the right well to put it into. There's a little bit of a lag. So let's just call it 6 to 9 months before it fully starts cash flowing. And then the amount of cash flow depends on how much leverage you have. I mean, some of them you buy it all for cash, so there's zero leverage risk, and so that you're going to start getting sort of consistent payments. But if you have a loan on it, it also depends on the length of the loan. The ones I do that have the highest leverage is just a 1-year loan. So most of your returns in year one are going off to pay off the loan, and your returns really don't kick in until year 2. And then there's others that are doing a 2 to 3 or 4 year loan period, so that gets spread out a little bit more. So, but the cash flow starts pretty much, I would say 3 months after the machine gets put into use, and that can vary just on the setup side.
Awesome. Let's talk a little bit about the risks. So obviously there's market risks. If the price of oil goes down, then you're going to see lower returns. But can you enumerate the risks outside of that, or maybe including that?
Yeah, I think the largest risk is we talked about just a little bit is that you are a general partner. So theoretically you have unlimited exposure, which makes a lot of people, rightly so, very uncomfortable. And that's something you just have to look into your own personal investment philosophy, whether that's something you want to do. The nice thing about the general partner thing is that usually you're a general partner for a limited amount of time. It's usually about a year. So, for example, if I don't know, it's the beginning of this year, I don't know if it would be January 1st of next year or the year after that, you would then be moved from a general partner to a limited partner. So that's the exposure, but that one's for a limited amount of time. And then if you want to get the leverage, then you do have to personally guarantee the loan. That's how you get that deduction on the multiples. Now, fortunately, we figured out a way with the tax accountants to limit that personal guarantee just to the amount of your investment, right? So if I put in $100,000, I'm going to personally guarantee $100,000. If for whatever reason the investment goes south or whatever, then we haven't paid off the loan, then not only are they going to go after the cash flow of the machine, they're going to come after you, but we're going to limit it to the amount of money you put in. But again, that's another thing that people are, especially if you're going to get a 2x, or one of them we did, I think, was a 3x. So you put in $100,000, you have to personally guarantee $300,000, and there's a risk there that's, at least for the first year, that if it doesn't come through, you might be on the hook for that. So there's a lot of negatives there. Those to me are the two big ones. I'm not so concerned about the price of oil. We don't benefit too much when it goes up or goes down, because these are contracts that have been in place. These are already predetermined contracts, and these are pretty long. I think they're like 10-year contracts that you have with these big oil producers or oil operators. But to me, those are the two big ones: the unlimited exposure on the GP side, and then having to personally guarantee the loan, which is why some people don't want to even deal with a loan. They just want to go and just do the regular stuff.
Awesome. So one more question before we switch into the final segment of the show, the 3 questions we like to ask all our guests. But one more question for any of our listeners that are listening to this and they're thinking, okay, this is something I'm willing to accept, that risk of being a GP for a year. I'm willing to accept the fact that I'm not getting any principal back. It's a pure tax benefit and cash flow play. They're really interested in doing this. How do they find these types of investments? Is there some easily discoverable market for them? Are there 1 or 2 big operators?
No, yeah, there's actually there's really. It's not something that's advertised out there. So I became aware of this because obviously I'm a securities attorney and I represent the client that actually has these investments. So that's how I became aware of. And so it's difficult to uncover them, but I'm happy to. I mean, I obviously don't do it myself, but I'm happy to connect people. If somebody's interested, they can just reach out to me, and I'm happy to make an introduction. Maybe they can just. I didn't think this through too much, guys, but maybe they just go to the website, premierlawgroup.net. Just you can connect through me there, and just maybe put on the title, oil and gas, and that way I know you're interested in me making a connection. Or I do have some collateral too. I can probably send some collateral to whoever's interested, and then if they want an introduction, I'm happy to make an introduction.
So, as Jay mentioned, we're going to transition now to the three questions we ask all of our guests. So, are you ready?
No, I hate these. Go ahead.
We have to do it. We have to do it. It's not hard, I promise. So,
All
the
right, all
first
right, all right.
question is obviously, you've just mentioned that the three asset classes that you're invested in currently are real estate, precious metals, and obviously oil and gas, what we've talked about for the last few minutes here. But have you looked into or are interested in any other asset classes? What recently has sparked your interest in maybe some other asset class, or have you learned something about one of those three asset classes that you didn't know about that has just changed your thinking?
Bitcoin. Bitcoin is something that's been on my radar for a while. I wasn't a big fan of it the last huge, and when I say the last, back 2016, 2017, obviously the new thing. But I was always super. I didn't like the asset class because I was convinced, and I could be right or wrong. So I was convinced that there's no way that the U.S. government was going to allow this to become anything. They don't want a competitor against their dollar. So I was just like, the odds of this thing getting shut down by governments is off the charts. And because of that, I didn't want to invest, or I shouldn't say invest. I didn't want to speculate because there is a difference between investing and speculation. But recently over the last year or so, I'm getting more and more convinced that although this is clearly going to be a lot more regulation involved, I'm not as convinced anymore that this is going to get shut down by the U.S. government, or whether they can shut it down, especially. And so, the adoption rate's been going on. So that's something I've been super interested, not only from an investment standpoint, but just to give you guys a little preview here, but also just from the blockchain technology and how that, I definitely believe that blockchain technology is going to revolutionize our industry, the syndication industry. I think 5 years from now, 10 years from now, the tokenization of syndications is, well, it's already there. I mean, I get probably 2 or 3 calls every month about people asking me about how do I tokenize my real estate? How do I tokenize a syndication? And I'm not quite equipped to handle those yet, but by the end of the year, that's going to be part of our practice, because I just foresee this in 5 years. Probably half of the syndications I think will end up being tokenized and being able to trade freely. A year after purchase, you're going to be able to put these on exchanges, and you're going to be able to start trading your syndication interest. So, but long story short, coming back, I'm really fascinated with Bitcoin, and I've been paying a lot of attention to Bitcoin lately. I'm paying a lot of attention to the current drop in the price, and I think at some point very soon, I do believe it's going to continue to go down, and that's when I'm going to start dabbling in that, I think, a little bit, and that'll be my fourth asset class.
Yeah, we could probably talk about crypto and Bitcoin and blockchain for another 2 hours. I will say, for any of our listeners that were intrigued by your comments about tokenization and using the blockchain to facilitate real estate transactions, I recommend going back and listening to one of our earlier episodes with Alexander Kanan. He's an attorney. And we talked all about tokenization. We had an amazing conversation. So definitely everybody go back and check that out. Let's jump into question number 2. And so this is all around legislation. You being an attorney, you probably have some thoughts here. But what's the current legislation or economic situation that you think poses the greatest threat to your passive investing strategy?
To my personal passive investing strategy?
Yeah.
Well, for me, it's got to be a change in the tax code. That would be my biggest. If there's legislation that comes out, for example, on the real estate side, they keep coming out with proposed legislation, or try sticking legislation to eliminate the 1031 exchange tax benefit, for example. And time and time again, it gets put into a bill and it gets rejected. For me, it'd be something similar. There's such an anti-oil and gas sentiment out there that the administration just wants to get rid of that working interest benefit. And if that went away, I wouldn't say it's 100% of the reason I'm in there, but it's probably at least 50% of the reason I'm in there. So if that went away, I would then move away from that asset class, and I think then I would be going back to, which I'm already going to go back, but then I'd shift over to real estate, because that has that, in addition to the 1031, the depreciation. That's really the main thing I'm looking for, is the depreciation. I don't think that's going to go away, because people always need to place a roof over their heads. There's always anti-sentiment about oil and gas and greedy oil companies and all that stuff, even though that narrative isn't necessarily correct.
Let me ask you another question in that vein, since we have you on the show and you are one of the premier syndication securities attorneys in the country. So I'm really curious your thoughts on the rumblings of potentially the accredited investor definition being changed by the SEC. Basically, the SEC deciding that to be an accredited investor, you have to have a higher net worth or higher income. There's been lots of talk about that for years. What are your thoughts, if you're willing to go there, on the likelihood of that happening?
I will. I've actually been on the record, and I'm going to do a quick, if you don't get some, I'm going to do a little plug, because I do a live every Wednesday, and tonight's live is actually going to be on that exact topic. So it's the Real Estate Syndicator live show. But I've been very vocal about, I do believe that the accredited investor limits will be increased. So right now it's $1 million of net worth, excluding your primary residence. That $1 million, that legislation was out in 1982. And that, adjusted for inflation, you're close to 3 million. I think it's 2.9 million in 1982 dollars. So it makes sense for the limit to be increased. And it also makes sense because in conjunction with that increase in limit, they're also actually expanding. Not only are they've already expanded the definition of accredited investor, and they're going to continue to expand the definition. So there's going to be in the near future certification programs that you can take, a course you can take, pass an exam, and become an accredited investor that way, irregardless of your income or net worth. And so when that happens, a lot more people are going to be able to become accredited investor. And so it kind of makes sense to me in my perverse mind that they would increase limits so that people now who, yes, if you're over $1 million but less than 3, you were an accredited investor and now you're not, but you can now go take an exam and become an accredited investor through that secondary vehicle. So it's almost like, do you want to be an accredited investor for free, or do you want to be an accredited investor by taking the exam? And it's just the free option that's going to go up. And I do believe that it's going to go up. If I was a betting man, which I'm not, I would say it's going to be somewhere around that $2.5 to $3 million. There's some rumors about 10 million or whatever, and I don't think that's going to happen. But $2.5 to $3 million, I could definitely see that, and it makes sense in conjunction with this expansion of the definition that's going on at the same time.
Is there a timeline that the SEC typically follows? Like, do they make announcements on a regular basis, or could this just get rolled out tomorrow?
Well, there are timelines, but the government's never follow those timelines. So the timeline was supposed to be April. So in April of 2022, they were supposed to come out with the proposed rule. And so once the proposed rule comes out, there's usually a comment period, 30, 60 days, where people can, people like you and I and the three of us can send letters to the SEC and say, this is a great idea, this is a terrible idea, it should be higher, it should be lower, whatever. And they take those comments into consideration. And then usually about 3 quarters later, they come out with the final rule, and they either have taken into account those comments and changed it, or sometimes it's the same. But the final rule usually comes out about 9 months or 3 quarters after that. But as of now, we're sort of at the time of this recording, we're kind of in the middle of May. We have not seen that proposed rule. So I wouldn't say I'm checking daily, but I've got my eye open, and as soon as that comes out, we'll be doing some kind of an event to talk about it.
All interesting stuff. So we're going to transition now back to the 3 questions.
Ashley's so mad at me for derailing the conversation.
No, I actually found it.
Myself.
I found it extremely interesting, and I think we could go on for at least another hour on this topic alone. But just to revert back to the 3 questions, the final question is, what is the best piece of advice you have ever received? And if that is stumping you, you can also say what is the best piece of advice that you have ever given or know of. It doesn't necessarily have to be the best piece of advice you have received personally.
Just give us some advice. Tell us what to do.
I've got a quote in mind, and I'm going to butcher it, so I want to get it right, but it's on topic here. But I'm a big, one of my mentors is Jim Rohn. And he has a great quote as something to the effect of, I'm going to totally butcher this, but it's something along the lines that, your wages will make you a living, but your investments will make you a fortune, or something like that, which goes to the theme of this podcast and what we do, is that, it's very difficult to become wealthy or financially independent by just going to work every day, getting paid a paycheck, and sort of saving that paycheck or doing whatever you're. But taking that excess paycheck and putting it into investments, whether they're passive or active, that's what's really going to grow wealth for you and your family, and bring you to what really I think most people should be focused on, which is financial independence, not necessarily wealth or rich. That has different definitions. But if you can get to financial independence sooner rather than later, that, and Jim Rohn would also say, that should be everybody's goal, is to become financially independent as quickly as possible. But that's going to be done through these passive investments or active investment. It's not going to be from your W-2. So if you're not yet started passively investing, then take that excess income that you have from your day job and start putting it towards something, because that's what's going to make you a fortune as opposed to a living.
Wages make you a living, profits make you a fortune.
There you go. That's what it is. Thank you, Jay.
Very well said by both of you.
Hey, I had the ability to look it up while you were talking, so I had the advantage there.
Wages will make you a living. Profits will make you a fortune. That's a Jim Rohn quote. And if you not, here's another big piece of advice. If you're not following Jim Rohn, who unfortunately passed away about 10 years ago now, you should definitely have him on his radar. Tony Robbins is one of his disciples, so he's the Tony Robbins mentor. Jim Rohn, ROHN.
Excellent. Thank you so much. And thank you again, Mauricio, for joining us today. If you want to hear more about Mauricio and connect with him, check out premierlawgroup.net. If you've enjoyed this episode and you want to listen to more, you can tune in to your favorite podcast provider. You can also check us out on YouTube at The Passive Investing Show. Make sure to like and subscribe. We hope this episode provided information, education, and some motivation to help you continue your journey of having your money work hard for you. Thank you again for joining The Passive Investing Show.